Hi everyone, I am Dr. Raj. I am very happy to interact with you all through this video. In this video, I am going to explain the concept cost volume profit analysis, which is shortly named as CVP analysis. These are all a couple of details related to my career. After you watch the full video, if you find the video useful to you, give a like to the video and do subscribe my channel so that you get the notifications of my future videos. Cost volume profit analysis. Nowadays, the amount of profit earned by a business concern is a criteria for judging its success. That is why all business concerns do want to maximize their profit. Obviously, the success of every business enterprise, irrespective of its type, is considered or judged through the profit. The amount of profit is dependent on three factors such as cost of production, volume of sales, and the third one is about the selling price. These three factors are interdependent, and the amount of profit earned by a business enterprise is greatly influenced by these three interdependent factors. One is the cost of producing the product. Number two, the volume of sales, and the third one is about the sales value or the selling price. Why do we say that these three factors are interdependent? The reasons are listed down. Cost determines selling price to arrive at the desired level of profit. This is what beautifully said in marketing. Cost sets floor for pricing, whereas demand sets a ceiling for price. Beyond a level, if you increase the price of your marketing offer, obviously the demand will get fluctuated and it will fall down. So, to set selling price for a marketing offer, the companies really consider the cost of making the product, plus to arrive at the desired level of profit, which could be charged on the cost and arrive at the selling price. Definitely, cost plays a vital role. The next point of consideration here is the selling price affects the volume of sales. As I said, for the products which are related with elastic demand, you can increase the price only up to a certain level. If the price keeps going up, the demand for the product will come down, and vice versa. The next point here is the volume of sales is directly affecting the volume of production. If the sales volume comes down, obviously the company should also bring down the volume of production. If there is no sale beyond a certain quantity of a given product, the product should be produced only for the quantity that is demanded. It should not go beyond the demand of the product. The next point here is the volume of production in turn influences cost. If the volume of production is increased, the cost of making every unit will come down. It's because the fixed cost remains constant up to 100% utilization of the production capacity. If the volume of production comes down based on the decreased demand for the product in the market, obviously the cost of making every unit of the product will go up. These are all the reasons why we can very well say that cost of production, volume of sales, and selling price are interdependent factors. Meaning and definition of CVP analysis. To understand the interrelationship between those three factors, a special management accounting tool has been developed which is popularly known as cost volume profit analysis, shortly called as CVP analysis. There is a definition given by Heiser. He puts it in the following words: the most significant single factor in planning of the average business. So to plan an average business, what is the most significant single factor is considered? It is nothing but the relationship between the volume of business, its cost, and the profit. Hence, cost volume profit analysis is an attempt to measure the effect of changes in volume, cost, and price on profits. With the increase in volume, unit cost of production decreases. If the volume of production goes up, obviously the cost of making every unit of a given product will come down, and vice versa. It's because of what reason? The fixed cost are constant. With a decrease in fixed cost per unit, obviously profit will be more. Yes, if the volume of production goes up, the cost of making per unit will come down. It's mainly because the fixed cost could be recovered through more number of units. And obviously, the fixed cost for every unit will also be reduced if the volume of production goes up. It's because of that, in the contribution per unit of the given product, you find there is an increase in the element of profit when there is a decrease in the element of fixed cost. The assumptions of cost volume profit analysis. The cost volume profit analysis rely on the following assumptions. Number one, the analysis assumes a linear revenue function and a linear cost function as well. Number two, the analysis assumes that price, total fixed cost and unit variable cost, that means variable cost per unit, can be accurately identified in the given situation and they remain constant over the relevant range. The relevant range is 100% level of utilization of the production capacity. The third assumption here is the analysis assumes that what is produced is sold. Whatever the product produced, whatever the quantity of the product produced in the factory of a company is sold. And the fourth assumption here is for multiple product analysis, the sales mix is assumed to be known to the people who involve in the analysis. Then the fifth assumption here is the selling prices and cost are assumed to be known with certainty. We believe that there are no great fluctuations with regard to the selling price and cost of making the commodity. And the last concept to be discussed in the video is uses of CVP analysis. The cost volume profit analysis can be used to answer questions such as how much sales revenue should be made to avoid losses. This could be very well computed by people who are in charge of management accounting, that how many units of a given product at a given selling price to be sold in order to avoid loss by the business enterprise. Number two, what levels of sales revenue must be achieved to earn the desired profit. If the management of a concern asks the management accountant to calculate the number of units to be sold at a given price to earn a profit of, say for example, 10 lakh rupees, he can very well do the computation and arrive at the number of units to be sold at a given price to earn the desired profit of 10 lakh rupees. It is made possible with the support of CVP analysis. The third question, what sales revenue must be achieved to recover the fixed cost? It is nothing but computation of break-even point sales. At break-even point sales, the sales revenue will be equal to the cost incurred. In that level only, we find the total fixed cost is recovered. And beyond that break-even point, if sales goes up, the company is going to start earning profit. The fourth use of CVP analysis is the answer for this question. What are the implications of increase or decrease in cost per unit or fixed cost on profit? So you can understand the impact of decrease or increase in the cost per unit, and specifically the change in the fixed cost and their impact on the profit earned by the concern. The next one is about what effect will price change have on profits. The price change is necessitated because of the changes in the cost of the input or change in the perceived value of the product. Therefore, what is the impact or effect of change in price on profit could be understood with the support of CVP analysis. The next one is about how will profits be affected by different levels of sales. That means what? At a given quantity, what would be the profit? If the quantity of units to be sold is higher, and what would be its influence on the profit? This particular analysis could be done through CVP analysis. And the next one is about which product or product mix is the most profitable one. Yes, companies normally manufacture more than one product. In that occasion, you can also find the fact that same material or similar materials could be used for manufacturing one or more products. So in that occasion, we can very well find out which would be the most suitable product mix which will give the company or business enterprise the maximum profit. So this could be understood through CVP analysis. And the last one is about, should we manufacture or buy a component? So a company can decide on whether to make a component or to buy a component. Is it really profitable if the component required for the finished product manufactured in the factory, or is it profitable if the same component required is bought in the open market? This could be very well taken with the support of CVP analysis. Thanks for watching this video. If you find the video useful, give a like to the video and do subscribe my channel. I'll meet you in another video. Bye for now, everyone.